China stocks popped close to 10% in the last 1 week. But is this rally sustainable, or is it going to fizzle out like the recent rallies? Like a guy who's got erectile dysfunction, he just can't stay up. Or is this time different? Could this time the market start to really perform? Let's find out in this video. Okay, so let's talk about China's stocks. For those of you who have been invested in the Chinese markets for the last couple of years, myself included, I've got about a 7% allocation to China. Some of you may be feeling a bit frustrated because in comparison, the US market is up double digits this year and it's almost retraced back the entire decline of the bear market, whereas the Chinese market seems to be still going nowhere. And every time there's a bit of a rally, like a rebound, it tends to fizzle out. So it's understandable that a lot of investors are just as skeptical with this rally, saying that it's not going to last, I'm going to sell out before it collapses again, and it's never going to recover. All right. So let's take a very unemotional, unbiased, and objective look at the Chinese markets to see, is there hope for a true rebound? And could this particular rally be the one that's different? All right. So we're going to study the markets both from a technical perspective as well as a fundamental perspective. Now, before we start, let's go back to a bit of history to understand how this bear market in Chinese stocks happened in the first place. Now, so understand that the reason the Chinese market went down was because of a self-inflicted wound, right? So the Chinese government themselves, in a way, they caused the crisis back in late 2020, early 2021. So that was when Chinese markets were at a high. So bear in mind that I'm using the GXC ETF as a proxy to the Chinese markets. The GXC is the S&P 500 China ETF. It is kind of like the S&P 500 of China, right? So this ETF consists of the about 900 biggest Chinese companies, mainly listed on the Hong Kong markets that are available to foreigners. So the crisis started when the Chinese government, they started to crack down and regulate the technology companies like Alibaba and Tencent and Meituan. Because at the time they felt that these tech companies were getting too powerful, too monopolistic. So they wanted to break up the companies because they felt that, yeah, you're making a lot of money, but at the expense of the common people. So they wanted to promote like common prosperity, where they wanted to put socialist values on top of capitalism. Then, of course, all these regulations caused a drop in the sales and profits of these tech companies. Then they went after the education companies, saying that you're charging too much and you're causing the students in China to study too hard, So they cracked down and they literally wiped out the education sector, right? And then they said the property sector in China was in a bubble. It was overvalued and they were overbuilding and all that. They say we're going to pop the bubble before it pops itself. So they started to over-regulate the property companies, saying that you have to reduce your debt and stuff like that. And so what happened was the property companies, a lot of them couldn't reduce their debt and many of them blew up. So that caused the entire crisis, if you will, all right? So again, it was purely a self-inflicted wound. And since then, we went into a bear market in China, right? The bear market from the peak to the trough was a 60% drawdown. It was really, really painful. And I think that a lot of investors, a lot of foreign investors, they got very, very disillusioned by China. It's like, how can you do stuff like that, right? How can you just come in and wipe out the education industry? You come in and you regulate the tech industry and, we can't trust the government anymore because, overnight, all my investments can be gone. And so a lot of foreign investors say, screw it, I'm out of here. And they all basically, sold and got out of China. And they did not dare to stay invested in China. And they said that now China is uninvestable because the Chinese government doesn't care about capitalism, they don't care about profits, they only care about socialism. So initially, the Chinese government thought that they could control the whole thing. They could have the best of both worlds. They could regulate all the companies, keep them in line, and have a booming economy. But I think things have really gone out of control. And now they've come to realize that, oh shit, we screwed up. Because the Chinese economy has tanked. The stock market has tanked. Property prices have tanked. And many foreign investors are not daring to come back because they have got, jilted in the past, and they're afraid that if I come back, we'll get hurt again by you. So they've come to realize that they can't have it both ways. That in order for the economy to boom again, the stock market must go up, the property prices must go up. And for that to happen, they got to get the foreign investors back. They got to get confidence back. And that's why right now the Chinese government is doing a complete 180. Now, of course, Chinese, they want their face. So they can't admit they're wrong. But from all the things they are doing right now, it really shows that they've done a complete 180. So I'm going to talk about that in a while. So initially, at the last quarter of last year, they said at first, okay, we're going to ease up on regulations. So that is what caused that initial strong rally in late of last year, early this year, right? Which drove the market from a bear market into a bull market. But then it hit a snag. So let's take a closer look at what happened. It hit a snag, right? So it went all the way up to about the 23rd of January. And then we had the Chinese spy balloon incident, and then some geopolitical problems between China and the US. And then Chinese economic indicators came in weaker than expected. And then people were doubting are the Chinese government serious about really stimulating the economy? So a lot of the doubts came in. And then we had a pullback from that strong rally in January. And now we are here, okay? So I'm going to look at the market where we are right now, again, from a technical perspective. And then we're going to look at the fundamentals. Do we really think that the Chinese government at this point of time, they are really, really serious about doing whatever it takes to bring the stock market back? And I think they are. I think they have gone into Avengers mode, Avengers Endgame, where they say whatever it takes. I think they are there right now because they realize that if we don't do something, if we don't do whatever it takes, it's going to get really, really bad, right? So I think that's a good thing. So that has caused what we call like a Chinese government put on the markets, where it's not going to go lower from here. They're not going to allow it to happen. They're going to do whatever it takes to pump up the stock market. That's from a fundamental perspective. So let's take a look at the technicals and let's see what we can read from there. So first, what's interesting is that, again, if you take a look at the price action, right? So this was the bear market. As you can see here, again, we had that 60% drawdown. Now, from the bottom in October last year, we had this strong rally up, right? So this drove the bear market into a bull market. Remember, the definition of a bull market is when prices close 20% above the low. So this was more than 20%. This was a bull market reversal, right? So bear market to bull market. Now, so since from that point to now, has that bull market actually died? Well, based on the price action, no. The bull market is actually still intact. Why? Let me explain. Again, this is purely through technical definition, right? So again, for the bull market to fail, you need a 20% close from the high. So if you take a high from here down to here, is it a 20% or more close? No, it's actually 19%. So technically speaking, this pullback over here did not invalidate this new bull market. So officially, we are actually still in a bull market. Now, if you guys understand Fibonacci, right? So you know that this is what we call a wave up pattern, right? Wave up, we call this the start of the A to B wave, okay? Now, from B to C, this is actually a 61.8% Fibonacci retracement. Can you see that? Exactly 61.8% Fibonacci retracement. Now, if you understand Elliott wave patterns and technical analysis, you know that when you've got a pullback that is within 61.8%, that is still considered an uptrend. Now, of course, if it closed below 61.8, then this would invalidate the bull market. That means we are back in a bear market. So that has not happened. So in fact, what happened was that the market pulled back, and in June, we hit a low here, exactly at the 61.8% Fibonacci level. So from there, it has rallied back. And by the way, these are weekly candles. we have now closed back above the 50 moving average on weekly candles. So if you ask me, I think that this is pretty encouraging price action. Now, of course, the next level of resistance the market has to contend with would be here, the high here, and it couldn't break that high. So right now, I foresee the market's going to retest this area over here, which on the GXC is about $91, right? So that's the next area of resistance. And from where we are right now, let me do a measurement, right? From the close on Friday, we have got roughly about, let's see, another 12% to go before that resistance is tested, okay? Now, let's take a look at the daily candles. Let's zoom in to a shorter time frame, and let's see what the daily candles tell us, okay? Now, based on looking at the moving averages, you can see that, well, let me just remove this Fibonacci indicator over here. Okay, that's a bit clearer over here. So technically, you can see that the price has closed back above the 200-day moving average, which is this red line, right? And the 200-day is actually beginning to slope upwards, okay? So when a price closes above the 200 and the 200 slopes up, that is also an indication of an uptrend, okay? So on the daily time frame, we are back on an uptrend, and on the medium to longer term time frame, like I mentioned, the bull market is actually still intact. The bull market has not yet been invalidated. Now, this is from a technical analysis perspective. Now, from a fundamental perspective, if you look at individual companies, many of the blue chip companies in China, they're actually doing pretty well. They are making money, they are generating positive free cash flow, and they are very attractively priced. They are very undervalued, right? So, for example, everyone's favorite stock, Alibaba. Alibaba, if you look at the company itself, it's doing pretty well, right? It's making money, it's growing its free cash flow, and if you look at the intrinsic value, last I calculated is between 197 and 229. So it's now, again, 50% undervalued. If you look at the price action of Alibaba, you can see that, yep, short term, it is back on an uptrend. You can see this was a bit of a downtrend over there. It's kind of like a downward wedge pattern. And this is like an uptrend pattern over here, right? So wave up, wave down, wave up, wave down, wave up. And it's above the 200 moving average, 200 sloping up. Same thing with Tencent. Same thing with Ping An Insurance, China Construction Bank, Bank of China. These companies are fundamentally making money. They are undervalued, and the overall index is below the historical PE ratio at about 9 times earnings. So you can see the 10-year average price to earnings ratio of the Hang Seng Index is 11.2 times earnings. And currently the index is only at 9.3 times earnings. So it is relatively undervalued based on historical PE compared to the US S&P 500, which is at 26 times earnings. So yeah, Chinese stocks are cheap. But again, you should know that it doesn't matter how great the companies are. It doesn't matter how cheap the stock is. If people don't buy the stock, it ain't going up. If foreign investors don't have the confidence to come back to China, the stock's not going to go up. So ultimately, will confidence come back? Ultimately, will the Chinese government do whatever it takes to rebuild that confidence? So like I said, I think they've finally gone into the Avengers Endgame, whatever it takes mode. So what happened? Well, during their last Politburo meeting on the 24th of July, China's top leaders, they came together and they pledged more policy support to boost consumption, consumer spending, tackle unemployment, and the ailing real estate sector. So there are quite a number of key changes in tone at the meeting that, again, is a complete 180 degrees from what they talked about previously. So what were some of the changes? Well, regarding the capital markets, which is the stock market, the bond markets, right? So previously they would say we're going to steady the markets, keep it steady. But now they've shifted the tone to promote market activity, which means they now want to attract, people to buy stocks. They want the stock market to go up. Second, regarding property, previously they've always said that we don't want property speculation. House is not for making money, it's for living. All right, and they wanted to squash any kind of profit-making incentives in the property market, and they realized that they can't do that. If you do that, property prices are not going to go up, and the economy is not going to grow. So now they've shifted a tone to saying, nope, we are not going to say that anymore. You can, basically make money from property, essentially, right? Regarding local government debt, from the past, they said we're going to strictly control the hidden debt, to now we're going to optimize debt level. Currency, now they're saying we're going to steady the exchange rate at a reasonable level. And most importantly, for the stock market, they are now focusing on promoting market activities to increase the index from its current level. So again, now they are clearly focused on increasing the stock market price level, And like I said, once they are focused on this, they will do whatever it takes to make it happen. Now, in addition, last week, regulators are also ready to grant the largest tech firms broader leeway in backing startup investments. So again, this is a complete 180 degrees, because what happened was a couple of months ago, the Chinese government, they were like forcing Tencent to give up their strategic investments. They forced Alibaba to divest many of their investments because they said, we don't want the big companies to have a stake in other companies. But now they realize they can't do that anymore. So now they are promoting these big companies to again invest in smaller companies in order to revive startups, startup companies. And in addition, China's market watchdog last week has consulted securities firms, brokerages, for possible measures to boost stocks, including cutting the stamp duty, which is the tax that they have on buying stocks and selling stocks. These were among the steps proposed by brokers. So again, they're doing whatever it takes to push up the stock market. So following Xi Jinping's speech on Tuesday, 26 July, on these new measures, we saw the largest inflow of foreign investors, which is the green line. This is inflow, that's outflow. So we had the largest inflow of foreign investors coming back to China, and it was the highest inflow since 2021. So that is pretty encouraging. Now, again, are all foreigners going back into China? Are they all buying back into Chinese stocks? No, not all of them, right? There are some hedge funds and some fund managers who have entirely given up and sold out of their China position. And one of them is actually Cathie Wood, that runs the ARK Innovation Fund. In fact, on the 21st of July, she announced that we are completely out of China. And the brilliant fund manager that she is, she actually sold right there, okay, before the Politburo speech and before this huge 10% gain in the market. So we'll see who's right. So on one hand, you've got people like Cathie Wood who's saying that we're out of China, we're never going to go back in. And then on the other hand, you've got Michael Burry, the famed investor of The Big Short, that if I'm not wrong, he has now about over 70% of his portfolio concentrated in China. So who's going to win, Michael Burry or Cathie Wood? Only time will tell. So how about me personally? Am I bullish on China? Now, I would say that short term, I'm bullish. Medium term, I'm bullish. But long term, I'm more bullish on the US market. So like I said earlier on, currently, I've got a 7% allocation to China in my portfolio. Am I going to add more shares to my allocation? I'm not. I'm keeping my allocation. I'm not buying. And of course, I'm not selling. I think from a risk to reward perspective, at current levels, there's a very, very favorable risk to reward. Because again, if you look at a GXC, you can see that right now we are here, right? And that's the bottom. And I don't think we're going to go lower. I think the chance of the market going back down lower, I think it's less than 10%. So I think that there's a 90% chance that this is the bottom and it's either going to go sideways or it's going to go up. So I think the risk to reward is very favorable, right? And from current levels right now, if you take a look, let's say this is the risk you're taking. The upside is probably about 2 or 3 R. Okay, so you're risking basically 1 R to make 2 to 3 R up. So again, very favorable risk to reward ratio over here. Now, the way I look at it, I'm not surprised that, again, the market's very undervalued. But once confidence comes back in and the multiples expand back to where they were in the past and stocks get fairly valued, I think that China stocks can easily double or triple from current levels. Okay, so if currently I already have a 7% allocation in my entire portfolio and my stocks in China double or triple, that organically would grow the allocation to already about 14 to 20% of my portfolio, which is pretty huge exposure to the Chinese markets. And that's why I'm not adding more. Okay, so again, short term, medium term, I'm bullish, but in the long run, I'm still more bullish on the US markets. So in the long run, once I think Chinese stocks get nearer their fair value or above their fair value, I'm not going to stay. I'm going to sell them and I'm going to reinvest into the US markets. The reason is because in the US markets, you can see that in the long run, the stock market, which is the S&P 500, it tends to grow in line or above the GDP growth. So in blue, you can see this is the growth of US GDP, and you can see that it's always in line. In fact, right now, the S&P 500 is growing faster than GDP. And one reason is because increasingly, more and more of the profits of the S&P 500 companies are coming from outside the US economy. If you look at Apple, if you look at Nvidia, if you look at Tesla, for example, they are US companies, but more and more of their profits are coming outside of the US because they are more global companies. Whereas for China, you can see that in the long run, the stock market doesn't keep up with GDP growth. Now you can see that actually Chinese GDP has grown tremendously over the last couple of decades, right? That is the China GDP, but it does not translate to corporate profits as much as the US markets. So while GDP is growing over here, you can see the Chinese stock market, well, there are two indexes. One of them is the CSI 300. This is the index of the Chinese mainland stocks. And this is the Hang Seng Index, which is mainly the Hong Kong stock market. You can see that the stock market underperforms the GDP growth, whereas in the US it's the opposite. Stock market outperforms the GDP growth. And that's why in the long run, it pays more to be in the US markets because GDP translates a lot more to earnings per share growth and higher stock market returns. So in fact, you can see that in the last 15 years, China's GDP has grown at 500%, whereas an investment in the Chinese Shanghai CSI index has produced a minus 29% return in those 15 years. On the other hand, in the US, while US GDP has grown at 72%, the S&P 500 has grown at 318%, including dividends. So that's a very unbiased, objective view of Chinese markets. Hope you enjoyed it, and I'll see you guys in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.